Coming to you from the Tar Heel State, this is the Carolina Commercial Real Estate Connection, bringing you industry insights and hot takes from Carolina real estate experts, helping you begin, grow, and scale your commercial real estate portfolio. And now your hosts, Tony Johnson and Cameron Pearson.
Good morning to all the aspiring and active commercial real estate investors out there. Thanks for tuning in to the Carolina Commercial Real Estate Connection. If you enjoy the content from our show today, please like and subscribe to our channel. Today we have Paul Loukas, a managing partner at Cape Fear Commercial, on the show. Paul has been involved in commercial real estate since around 2010 when he joined Cape Fear Commercial. He became a managing partner in 2017. Paul has a wealth of knowledge in the development side of the business, so much that we learned from Paul today was all about development and how to get into development. And we barely just broke the surface, but I look forward to you being able to learn from all the knowledge he exposed in today's episode. So please listen in and get your learning ears on. Welcome to Carolina Commercial Real Estate Connection. We got Tony and Cameron here, and today we're with Paul Loukas with Cape Fear Commercial and Cape Fear Development. He's been with them. Paul, how long have you been with those guys?
So I joined Cape Fear Commercial in 2010.
So when you started in 2010, what did you come in as? How did that role happen, and how did you get in with them, and what was the plan there in the beginning?
Yeah, so just as a background, been in the business for 20 some years, or 20 years, probably exactly. And in 2010, the market obviously was in the middle of the Great Recession. Not many transactions were occurring. So I was a commercial broker and joined Cape Fear Commercial as one of the brokers at the time. And then became a partner in 2017. And there's two other partners, Brian Eccles and Ben Wells, who started the company in 2001. We have three verticals. We have commercial brokerage, where we participate in all product types, selling and leasing of property. And 80% of our assets, or the deals we work on, are about within an hour and a half drive from Wilmington. But we brokered deals in, I think, 18 states. But generally speaking, 80% of our projects are within an hour and a half drive of Wilmington. On the property management side, we manage over 3 million square feet. Once again, all product types, and mostly in Wilmington. And then we have a third party development arm that we do some build to suits. We have been engaged to develop Autumn Hall. So right now we are, I think, on our fourth or fifth office building in that mixed use project. And then aside from Cape Fear Commercial, we have a sister company called Cape Fear Development, where we are largely developing apartments. We have over 2,000 units in some form of development right now, from pre-entitlements to delivering units.
Is that project on Fully Internet I saw?
No, that's not us. We're doing the brokerage on that, the retail leasing on that, but we're not involved in that project. Hudson Renaissance, which is right around from where we're sitting right now, is one project that we did.
Okay.
And then obviously we have some projects in Myrtle Beach, started a project in New Bern, about to break ground on a project in Carolina Beach, have one in Aiken, South Carolina, and a number of other ones.
Yeah,
Leland,
certainly keeping it busy. That's great.
Yeah, so obviously last 12 months has been interesting, coming out of COVID. I think everybody was extremely just busy in general.
Yeah.
And then last June, I think it was like the first or second week when the Feds raised rates, the market, you could feel the market shifting in general. And I think it got progressively more difficult to do deals, whether it's brokerage transactions or underwriting development deals. And largely the market has greatly shifted. And I think in our area, largely everything's doing very well and has fared, much better than the rest of the country, but deals are looking a lot different. I mean, they're taking longer to do because interest rates are, much higher than 12 months ago. Construction costs haven't come down. So it's, it's trying to figure out how to make a deal work. And fortunately, I think sellers have become a lot more flexible, and they're providing more, granting buyers more time, restructuring deals, and just trying to get creative to make things happen.
Well, with the rates going up as they have you seen a constriction from the banks on lending or?
Yeah, 100%. I mean, I think, obviously that's a broad statement. And I think, in generally speaking, it's getting more difficult to get financing. I mean, the loan costs have dramatically dropped. Interest rates have gone up. Certain banks have just pulled back on funding of certain asset classes in general. And, I think generally speaking, 12 months ago, a lot of banks wanted to look at almost every single loan opportunity there was.
Right.
And now it's, there's a select few that are really trying to aggressively look at projects.
Awesome. Well, man, you seem extremely busy, and obviously that's a lot you guys are dealing with the company. What is your core focus? So when you have your commercial brokerage, doing your leasing, you got the property management and the development arm, is your focus mainly on the development arm, or are you still focusing on the brokerage side as well? Or do you deal at all with the property management portion of your company?
So the three of us, myself, Brian Eckel, and Ben Wells, obviously touch everything in the company. I am broker in charge, so I technically manage all the brokers in our office. We have 15 brokers. Each one of us largely concentrate and specialize in certain asset class or geographical area. For myself, I largely deal with investment sales and development deals. So a lot of my work on the development of the brokerage, when I say development deals, I'm referring now to just the brokering. I do a lot with large residential developments. So selling either raw or entitled or fully developed lots to large regionals and national builders, stretching from, let's say, Myrtle Beach to Fayetteville to New Bern. But also on the same side, it's, we just sold about, I think it was less 3/4 of an acre downtown Wilmington on Front Street. We just sold for $6 million. And so
we were just talking about that the other day. That was a little bit insane.
It was, it broke all records. We technically don't know what the buyer is going to do with the project. Highest and best use is probably some sort of hotel and or multifamily component. The problem just with
soil is not, you're right at the river, right? So
correct. So
you get the compaction.
You got to go vertical to justify that price, which means steel, which means structured parking. So just costs are going to be, it's going to be very costly to build that project. I think this buyer, and this is just my assumption, this buyer saw the real estate. It was, a great, great asset, and just wanted to buy it, and we'll figure out in the future.
Yeah, obviously the location is fantastic. And I guess you got to really figure out when the dollars and cents, maybe if the cost of construction drops drastically, that it'll start to make a little more sense.
Yeah, part of it is, the idea that, there's two sides of that equation. One is the construction cost, and the other is the rent or the revenue that the real estate can produce. And, right now from the multifamily side of it, it's hard to justify steel construction when rents are, in the $2 range or so. And, same thing with office. Right now it's, that's a common topic that's, keeps getting brought up and asked, we get asked about is how's our office market doing? And it's doing great. It's phenomenal, actually. We haven't had a ton of supply built. Really going back to pre-recession, we had a sewer moratorium right before the recession that halted a bunch of potential supply. And then coming out of the recession, there's only been a handful of projects built. And today we have demand, but it's hard to underwrite deals when, maybe top of the market rents are in the $30 range and construction costs are, in the upper 200s when you consider build out. It's hard to make those numbers work. So really we have demand, we have limited supply. So our office market's doing really well. And, obviously, that's a headline in other markets where you see, the office vacancy pretty high.
Yeah, obviously, yeah. I mean, New York City, I think they're saying it's in the 30s, and I know San Francisco is really bad. But so I want to get back to a little bit, just back up a little bit on what you were saying. You're broker in charge, you specialize in investment sales, just to dig in a little more and find out more on your focus, your core focus, and what you're doing. So if I'm someone looking to find raw land to develop, kind of walk me through your process. You're dealing with investors. Are people are coming to you? I'm assuming you're offloading them, but you're dealing with the people that are you're bringing them the raw land, they're entitling it, then they're using you again to offload it to maybe D.R. Horton or national builders that are going to come in, right? It's just doing entitled or fully developing the land and then selling off them ready to build.
Yeah, that's a great question. So, obviously, I think I see the entire cycle of that. So yes, we sell large tracts of raw land, often to developers. And then
when you're selling the raw land to developers, how are you finding the raw land? Are you reaching out to these property owners and kind of striking and putting everything together based on criteria that the buyers are looking for? Or are you
it's not even that complicated. It's just that at the end of the day, we know the growth patterns, we know where the utilities are. So there's really only a handful of called submarkets and areas that development's going to occur. We talk to the builders every single day, so we know kind of generally where they want to be. And just look on a map, it's really not, at the end of the day, it's not that many properties. So we knew a lot of the landowners, and we talk to them often. And as an example, we just we're looking at a project right now that's in the city of Wilmington. It's an infill project. 5 years ago, we looked at it, and it was the owner's expectations were absolutely crazy. Talking to a national home builder, we were brainstorming. That property came up on the map. They said they could pay X per finished lot if we could find a developer. Finally, now the landowner's expectations may make sense.
Right.
So we're going back to the landowner and see if we can figure out a deal.
So you're putting together. So you've got the landowner in the pocket. You're bringing someone that is prepared to do the entitlement of that land, develop the land, get it pad ready, and then you've got the end buyer already in place as long as they can get it pad out. So like $25,000 a pad or whatever, as long as the developer can come to the agreed price at the end of the day. So you're having all that from start to finish. Is that right?
Yeah, the market shifted dramatically since, let's say, 2016 or so, and just now where pricing's going and sellers' expectations are, a lot of our deals are going directly to the builders who have to self-perform these projects. So most of them will not close on land until it's fully entitled. Mm-hmm. So depending on the structure, some of the builders are comfortable doing the entitlement work themselves, closing on it, and then performing. Some of them will do the entitlement work, close on it, and flip, or do a simultaneous flip to a third-party development partner. So it just depends in general. So, but a lot more now are getting sold directly to the builders from the raw state of land, but closings triggered upon some sort of entitlements, and mostly that's upon full construction drawings and permits.
Right. So they're locking the land up for a year of due diligence, roughly speaking, going through a TRC process, getting the civil layout of the land, make sure that works, then as they're going through the process, going through building designs until they get the full entitlement from the county, then when everything's permit ready, then they're ready to close. Their money becomes hard then with that landowner and they close within 30, 60, 90 days or whatever. And then it's off to the races, and those builders would then entitle it to a developer or develop themselves. Am I understanding what you're saying, right?
Generally speaking, yes.
Okay.
So as an example, we're about to close on a project in Shalot. It's 222 paper platted lots. So in other words, everything it's shovel ready, all the permits are received, we have the construction drawings, and we're under contract with a national home builder. They just came to us 15 days before closing and said, hey, we are assigning this contract to one of our development partners who's a group from out of state. They're actually gonna be the ones closing on it and developing it for us. And that happens often, sort of a fluid process, and it's a case-by-case basis.
And so how long this Shalot project, so you're saying they're assigning this 15 days from close, how long has this thing been under contract? So the builder, you brought them the raw land, right? And was this a project you're involved with?
On this project itself,
Uh-huh.
I was actually not involved in the transaction occurring between the landowner and call it the developer who's simply entitling it. The
Okay.
developer engaged us to do a formal marketing process to sell this project upon getting full permits.
Mhm.
As a side note, oftentimes in that process, even if their goal is to sell it paper platted, we still ask the builders, hey, what is your price? What is your absorption timeline? If we actually develop the entire project, fully develop it for you.
Right.
So kind of a check and balance to make sure that, they're making the right decision. And we went under a contract, let's say maybe 60 days ago.
Okay.
And closings should be sometime in June. And this builder loved the site, ultimately decided that they don't have capacity to develop it themselves. So they're going to flip it to one of the development partners so that they can develop it and sell it back to the builder.
And sell it back to the
Yeah.
builder. And they agree upon that rate, I'm sure, prior, so he's selling it to him and then assuming his fee for it and then agreeing to a buyback before it even closes on this part right now, right?
Correct.
That's interesting, isn't it?
Yeah, very much so. I was just, so it sounds like you have a lot of the deal or land that you find is off market. Because it's
100%.
Yeah, so this deal, the builder came to you, was this land still off market or?
The developer came to me, and I'm not sure what transpired, with the land itself, whether he reached out to the owner or whatever happens, I'm not sure for there.
Yeah.
So he already had, you're saying you weren't involved in the initial transaction with the owner, so he came to you and said, this is the piece of land, me and the owner have an agreement, and you basically came in and helped him find the builder to flip it to, or find the developer or tell me a bit about how you came into the situation.
Yeah, so obviously, we can use the word developer very broadly because some people are developers and all they do is get entitlements. And then obviously some people, are not comfortable with development or entitlements, and all they're comfortable with is putting the infrastructure on the ground, delivering a fully finished lot. And obviously there's people that are comfortable with, the whole entire process. This particular person is comfortable doing everything, and 50% of his projects, he does deliver fully finished lots, and then 50% he sells paper platted or fully permitted. So he came to me, we have multiple projects going on at any given time, and said, hey, I have a new project. I'm looking at this piece of land. I'm doing my due diligence. Let's see if we can get some interest from builders. So even during his due diligence phase, he engaged me. And at that point, it wasn't a formal marketing process. We were just trying to get some feedback from the builders. Hey, do you like this location?
What
if
was your
so,
favorite?
what, hey, we're designing this right now. What kind of product do you like to see here? Would you like to see any duplexes or all singles? If singles, are you looking at 50-foot wide, 60-foot wide? Do you want to see amenity? Are you comfortable paying more? If we do deliver amenity, what does that amenity look like? So kind of just gathering information so he can make an assessment whether or not financially could work. And then two, also taking that information and using it to steer how he entitles and plans the project itself. And then some point in the future, we go out with a formal marketing process and talk to the potential buyers. And as a side note, for a period of time, it's becoming less and less relevant right now. But, if this was 15 months ago, not only would we talk to the home builders, but we were talking to the guys that were trying to do build to rent projects. So build homes for a rental product. They were giving some very competitive pricing. That's largely dried up, at least in our area.
Right.
There's still some guys looking at doing some rental product, but it's far less prevalent than it was in 2022.
Yeah, I mean, it's still, as a nation, I still feel like that's where we're going, right? I think that a lot of these national guys are getting involved in the build to rent just because, unless it gets more cost effective, it just seems to make more sense for people. Although with what they've done with flipping the interest rates for the people with worse credit, maybe that changes things a little bit, but I don't know. So just going back to this. So let's just say, people listening out there are interested in getting involved in development. And so they're trying to understand what, this concept might be, if somebody hasn't developed anything or just developed, just a small piece of land, and maybe it was did a duplex or a quadplex, or maybe did a 16-unit, 20-unit building, right? But they want to get into a larger development, and to understand that's a little more complex, where they've got to entitle the land, potentially rezone the land. So walk us through an understanding of what the expectation should be for somebody doing something like that. How much money out of pocket is expected, and how much do you need to expect to have in reserve before you get into something like this? That's that long drawn out 1-year process. That would be question one. And question two is, typically with the guys that you're dealing with, are they partnering up? Are they having investors that are backing them up? Or are these people typically that you're dealing with mostly self-funded?
Yeah, it's a great question. So I probably wouldn't recommend anybody just jumping into any sort of development from the very beginning. But let's use an example of potentially 100 lot subdivision. You could be out of pocket on just the soft costs with permitting and engineers about $200,000. So you could put a property under contract and start that process and have to spend $200,000 just to get it permitted and everything else. And obviously there's a couple mistakes that I see often. Number one is there's a lot of people that have tried to get into the business because for several years they saw a lot of people making money. And when the music stopped mid last year, so just kind of going back to my conversation about the market shifting last year, is really almost October when they raised interest rates again, that I think almost every single one of our builder contracts were terminated. I think we revived every single one of them, but they had to get restructured, and everything's taking a lot more time. And there's a lot of people that put projects or put properties under contract, spent the money for the entitlements, and expected them to be closed or flipped by now. And they've lost a lot of money. They've had to walk away from deals, walk away from a ton of money because they just thought they could simply flip it, and they didn't have the staying power to weather kind of what's happening in the market right now. So that's number one. Number two is, oftentimes we get brought into a project. So I have another project also in central Brunswick County that we just put under contract yesterday. It is fully designed. And now we just spend another $50,000 to re-engineer because for some reason they completely over-designed the sewer, the stormwater, had some inefficient designs with, clearly they could have done some double loaded roads and lots on the roads and did single load instead, and made it very inefficient, but B, very expensive to develop. So, that was the person who originally designed it, clearly, let's just say didn't do a very good job at it.
So in a circumstance like that one, I understand the other one. So you're on the other one, you're going to be spending roughly, let's say $200K soft costs, just to go back, and then we'll come back to this one. But on the first one that you were giving an example, we got a 100-lot subdivision. So typically you would try, and for somebody getting into a development like this, you wouldn't expect a whole lot of money in the initial phase to get the property under contract, because you're spending all of that money on all your soft costs. So you can't, in essence, give them a bunch of earnest money or non-refundable money in the beginning. So you may give them a small amount of money and then pay as you go for a little bit if you need extensions. But most of your money in that development phase is going in all your soft costs. So you can't give a bunch of money down in the beginning, right?
Yeah, I mean, there's two approaches, and it depends on sort of how you're funded and your risk tolerance. There's an approach where it says, hey, I'll close on this within this piece of property within 75 days. I just want to make sure I understand the wetlands, understand the soils, understand the environmentals, do some basic due diligence on the physical property itself, and understand maybe the potential entitlements, whether it's current zoning, and your vested rights and things of that nature. But in exchange, I'm only going to pay you X. And then the other side of the equation is, hey, I'll go hard on some money and it'll go non-refundable within, it just depends on the 60, 90 days, depending on the type of project. And now I'm solely talking about residential, not multifamily, not a retail development. But it's gonna be a small amount of money, hard non-refundable, and closing will probably be from there another 6, 7, 8, even potentially 12 months, depending if it's a rezoning, the municipality, things of that nature. And I want to be able to take all the risk off the table and have it shovel ready.
And then you'll be able to pay
a premium, whether it's 20, 25, 30, whatever it may justify. If it's taking a rural piece of land where it was zoned or entitled for 2.5 units per acre, but you're able to get it rezoned for townhomes and get 6 units per acre, or even 8 units per acre. Obviously, potentially there's a lot more value in that. So in exchange, it makes complete sense to pay them an extra 30% on the original land value, because you just increase your yield by threefold.
So in essence, you're making that homeowner, you're making them wait longer, but almost bringing them in as a partner. So they're seeing that upside and getting more of the value that they may see the property being worth, but it's not worth that as it sits right now. So getting them to buy in on waiting a year and then getting the dollar amount that you're really looking for.
100%.
And just standing by. All right. So, I mean, that sounds great. What do you think on that, Cameron? Do you understand that, or do you have any questions on that?
Yeah, well, when you say a small amount of money on the front, so that obviously that per deal is gonna kind of dictate what that looks like. But is there usually a rough percentage like it is in the retail? I mean, in the residential side, where you're like, I'm putting 10% down. Or 50%?
I mean, there really isn't, and that's sometimes a difficult conversation to have with the landowner, because hypothetically, if the land is, the price is $3 million for the raw land, and somebody comes to the table and says, hey, here's $50,000 of earnest money, that does seem like a low amount of deposit day one. And
that's when you begin to structure that if we do these things, we're going to pay you more than you got to list.
Correct. And they have to feel comfortable that the person can execute, that person will follow through and actually engage an engineer and create this value and everything else. I mean, the goal is at the end of the day, in a perfect world, if the developer walks away for whatever reason, the landowner just inherited a ton of value by way of, third-party documents, site design, drawings and things of that nature.
Yeah, so you're basically saying to that homeowner, yeah, I'll give you the $50,000 non-refundable, but in essence, if this doesn't work out and I bail, I'll give you everything that we've invested, because we're going to be spending $150,000, $200,000 on all these costs, and we'll give you all that if for some reason it backs out and doesn't work. As a leverage.
Correct. And I often would argue that it's more than just the $150,000,
Yeah.
$200,000. It's the value that you created because you maybe solved a problem with sewer. There was no sewer to there. And you're able to, negotiate an easement with the adjacent landowner to bring sewer across their property, and things of that nature. So it's the, the value creation that hopefully is completed during that due diligence and time frame when it's under contract, so that if the landlord does, a year later, it doesn't close and the landlord's stuck with the property,
The value add.
it's a complete value add.
Well, yeah, I think anybody listening to this right now would be getting value add from all the information you're spitting out, Paul. I mean, this is extremely informative for anybody that's not that involved in development. Just the amount and how easily you're breaking it all down for people to understand. So helpful for anybody who's looking to get in. Obviously, it's very risky. Any development is risky, right? I mean, you definitely have to know what you're doing and if you don't know what you're doing, find partners that do know what they're doing, and, don't do it on your own. And we're not providing any financial advice or, real estate advice here. This is all just for information. But
yeah, 100%. I mean, obviously development, is extremely risky. So many variables, and everything else. The one thing I was going to add, I mean, we're involved in a project right now where essentially the closing is triggered upon a conditional rezoning. And it's great. Hopefully it does close, but the buyer has created so much value for the property that the seller is sitting back saying, I almost hope it doesn't close. And I know I won't be able to monetize this for another 2 years, but I mean, just to put numbers on the table, it's under contract, for around, let's say $6 million,
Mhm.
and it'll probably be worth not, maybe $10 million if this buyer doesn't close. So, it's a win-win, but that's an extreme case of the value creation. But we often have, when we represent, let's say, the landowner in that case, if they don't need the money, sometimes it's not the worst thing in the world if the buyer doesn't close.
right.
Yeah, that's pretty interesting.
And on the brokerage end, let's say, going through that lengthy process. So, if you're representing the buyer or the seller and we're structuring a deal that might not close for 6 months, a year, all your commission is held up all that time and you're investing all that time. So if, let's say, you go 9 months and this whole deal falls apart, like we were just saying, that the owner gets that value add, you're left with nothing. Is that right?
Yeah, 100%. I mean,
so there's a lot of risk involved with you guys. So you want to make sure that you're vetting these people before you're getting involved in these deals, right?
correct.
Because this is a commission business. This isn't like you guys are getting a salary for wasting 6 or 8 months with someone. So I'm sure you're picky on who you're bringing these deals to, right? I mean, that's your mindset when you're going into this, right? And if you've got 3 offers that have, even though one may be lower, you're more comfortable with that person. That's who you're going to recommend, right?
Exactly. So, at the end of the day, it's no secret who the logical builders are for certain projects. I mean, that's not where we earn our money. We earn our money by A, structuring the best deal, B, getting the highest price, and C, making sure we get to a closing. And we do have sellers who often are just enamored by the price, and
convincing them to take the realistic price is difficult.
convincing them to take a realistic price. And we had a client that did not take our advice, and a builder came in from out of market that has no projects in this area, overbid on it. The number didn't make sense. They terminated it. And so it's trying to explain to the seller, our client, well, that wasn't, they gave you unrealistic expectations.
Now the market's changed.
Now market's changed and the offers on the table are slightly lower. And actually, let me say this, the pricing really hasn't changed over the last 12 months. What's happened is the takedowns. So there was a period of time where it's, hyper aggressive, where you had these builders in our market, obviously these numbers are going to be different for Florida, Texas,
Right.
and Arizona. But, we were selling 300 lots at once. And, typically in our market, a big builder could probably deliver, 60, maybe 80, 100 homes a year in a subdivision. And that's like the best subdivision in that submarket after several years of being established. So when we sold 300 lots at once, they're just banking them for years. So now we're kind of, the market has shifted, is the pricing has either remained the same or maybe even slightly better, but the builders are coming back saying, hey, we need to, look at a different deal structure. Maybe it's just 100 lots day one, and they'll buy the remaining, let's say another 100 lots, 12 months thereafter, and then the final 18 months thereafter, after that one. So it's just different deal structures that are happening right now. But yeah, that's 100% correct. You want to make sure that you go with a client that, or a buyer that A, can perform, B, that is just not putting this under contract because they want to see if they want to do the deal. We want to make sure that they're committed to it, and they just need to check certain boxes in their due diligence process.
So is it difficult then for someone new? So let's say I want to get in on a development deal, but I don't have the background, but I want to be taken seriously. Am I smarter to find a development partner and have them join forces with me to give me that leverage and that stability that then I would be considered and not, pushed aside? What would be the best method to draw interest when I'm putting in an offer in a competitive situation like that?
That was a great question, Tony. I just want you to know that.
Well, I mean, before you made the last comment, I was going to say, well, what are you bringing to the table? So if you're bringing to the table, you're the potential buyer. Honestly, it's doing as much due diligence as possible up front. So when I do my buyer interviews and I say, so are you okay with that, 20-foot, easement that runs throughout the property?
You are.
And you say,
What easement are you talking
yeah, not only am I comfortable with it, here's how I think we can handle this. Or, like how you're going to deal with a lift station that's going to cost you $800,000 to build. How are you going to justify that? Are you concerned that the soils are bad or whatever it is? So doing as much due diligence as possible. I mean, obviously in a perfect world, as a seller, or if we represent the seller, the more information that we can provide to a buyer upfront, the higher the price is going to be, the more likely it'll close, because you're taking risk off the table, you're answering questions up front, and the buyer feels comfortable to come with a better offer. So, oftentimes when we go to the market, I get scared if I see an offer day one. I mean, how much due diligence could you have done? Were you able to talk to the, the planning department where you're at, did you really study the wetlands map and, understand, the potential crossings and everything else that are going to be impacted. So doing as much upfront work as possible, and I guess it's no different than buying a house. I mean, the buyer that's going to present the best is the one that comes with, pre-qualified mortgage and has already done, some work and things of that nature. So it's really different.
So that'll lead, just with that, that'll lead us back into where you were talking about the fully designed project that you had, where they went then 50K over and the re-engineering, and you said because you did over on the sewer and the stormwater, and it is fully inefficient on the design and expensive to develop. So in a situation like that, you typically would like to see somebody come in with a design build partner that could kind of help guide them through that. And some project that big, I would assume, this isn't their first one. So why didn't they have a, design partner helping them guide through and, the process as they're going through and say, this doesn't make sense. You have to look at this. So typically when I am a builder, and I'm not, some massive developer, but when I get in with anybody on, smaller infill developments or anything, and they're coming to me, I'm always telling them, let me go through the design phase with you. Let's help as we're going through engineering, and let's kind of value engineer. I'll give you your initial budget. Maybe let's get a 25%. I can run a budget at that point, and we see if we're kind of on track or going off track, and kind of staying in tune as the design is going through. So you're staying in line with those cost measures.
That's exactly right. I mean, in theory, assemble team up front, and that's your site contractor, that's your engineer, your wetlands consultants, and in theory, they all should be working together. And so if your engineer designs a plan and yes, run it by your site contractor to make sure that it's the most efficient and maximizing, maybe the site's unbalanced and there's an issue with the dirt. So, the engineer's only looking at X. So, the site contractor is looking at Y, so you kind of have to bring those people together. And I think it's no different than designing a house. I mean, I've heard so many friends.
Well, then you got those two, then you got the architect design manager here, then you got the engineer that has to take all the precautions, and your structural guys, oh, this thing's a mess the way you did this over here. So if you're not keeping them all communicating throughout that process, everybody's covering, it's a CO, what is that? COA, CYA, whatever it is. COA, I don't know what it is. But when you're covering all those, everybody's covering their own bases. So if you're not communicating and, doing these cost-effective measures all the way through and making sure everybody's understanding the most cost-effective and easiest and best path, if you don't have everybody communicating, you get lost, and that's where your prices go all out of whack. And then you're spending $200,000 before you even get pricing, and then you're like, oh my gosh, we're $4 million over what we budgeted. Oh, this is unrealistic. Let's go spend another $50,000 and redraw it and start all over. Well, none of this makes any sense. You're not saving any money doing that, exactly. And time either in this kind of an environment. So man, I mean, I've learned so much already, Paul, from you, man. I mean, I feel like we could sit here with you for like 6 hours, learning stuff from you. Yeah, I mean, I feel like we need to get you again. So we haven't let you talk much about, just because I've gotten so involved, because you have so much knowledge, understanding all your experience in development, that we haven't heard much more about, your being a partner in this brokerage. Now, you said, you've been doing this for 20 years and you started with them in 2010, which leaves a gap. So can we kind of back up and get a little story about you, what brought you into real estate in the beginning, how you got, info and understanding on these guys, how you became getting into such a great company in this area, and then became a partner. I mean, it's an amazing story. So understanding your story, I think, would be awesome if we can just take maybe 5 minutes and get background of your story, and then,
I'm not sure how interesting the background is.
We can't talk about it.
So after graduating college, for whatever reason, I always was fascinated by real estate. I had, half the guys that graduated from, went to New York and tried, to do investment banking. The other half got into consulting arena. None of that interested me. So I spent a couple months after college just talking to anybody and everybody that's associated with commercial real estate, bankers, contractors, brokers, and everything else. And I moved down here in 2002, and I started working with a company that allowed me to do some commercial brokerage. But at the same time, I was doing third-party asset management work for a major lender that was the structured finance department, where they're doing high risk, high yield lending. And at that time, or going into that time, it was a lot of cool projects like condo conversions and South Florida and New York, or whatever is recapitalizations or value add, multifamily, or whatever it may be. So I got exposed to a lot of the debt side and underwriting and things of that nature. And then slowly, I did that for a couple of years, along with commercial brokerage in town. And obviously the recession hit, so there was no more originations. So that third party asset management work stopped. That actually transitioned to a lot of bank work. And I was doing a brokerage deal with Brian Eichel and Ben Wells with Cape Fear Commercial. We talked for a couple of months, and ultimately I came over and started working for them. And coming out
through one deal.
Yeah, I mean, we had known each other, I guess, here and there.
Okay.
Just in business and in just one deal.
And they were like, this guy, he's a home run. We got to get this guy over here with us. How long? Wait a second.
I mean, I guess they like me.
So when did they start? When did they start?
So that's great. So Brian Eckel, but Brian and Ben grew up here. After college, they went kind of completely different paths. Brian was in Atlanta working as a tenant rep broker, dealing with like life science companies in Atlanta. And then Ben worked on the landlord side and worked for a big company there. And they had been talking for several years about, hey, can we come back to Wilmington? You know, form a company. Is there enough business in town? You know, kind of exploring that. And then they opened their shop September 2001, and kind of grown it ever since.
9/11, the same month as 9/11.
Actually, the first day in the office was 9/11.
No way. How about that?
Yeah, not a good day to open.
No.
Memorable though. You won't get that day. There you go. All right. So go ahead. So 2001. So 2001, they got the business going up and running. And they're like, man, what we need is Paul Loukas. It's time.
Yeah, the business plan. Yes.
What happened? So anyway, so they had brought it up when you started there in 2010. How many? I know you said you're broker in charge over 15 brokers right now, right?
Yeah.
Okay, so you have 15 brokers on your team right now. When you joined in 2010, how many brokers were there?
There was
alongside you. Oh, six.
Six
Okay.
or seven, yeah.
Okay, 6 or 7. So they had already started to kind of spread.
Yeah, I mean, they
wings
were
and get going.
Doing great. I mean, they you know, at the time they were doing I think they dominated the market then on the commercial brokerage side. On the party development side, they were doing a lot of Walgreens. They did some bank buildings over here and had a good footprint on the property management. Obviously, we had a recession. Coming out of the recession, we I think we've always tried to adjust to the market and really find meet the needs of our clients. So in 2000, started in 2010 and really exploded in 2011, 12, we started doing a lot of bank work, and we represent 21 of the 23 banks here locally.
Wow.
And some of those relationships, they said, hey, where can you go? So it ended up not being just Wilmington, but it ended up, you know, for one of the banks, we were in 5 or 6 states. Now, some of those we broker deals. Some of them we just went to the market, found the best broker and partnered with them. And we almost acted more of a third party asset manager in that situation. We were selling not only properties, but portfolio properties. We were selling loans, portfolio of loans. For some banks, we helped with the negotiations of any deficiencies and you know, any loan buyouts and things of that nature. So we got pretty involved, and then probably around 2015, I think our market kind of slowly recovered, and the bank work slowly, you know, their portfolios were slowly dwindling down, and you know, it's, you know, been good ever since. You know, on our brokerage side, like I said, you know, we have you know, each one of our brokers specializes in a certain area or product type. So Will Leonard in our office, you know, he touches almost anything that has to do with industrial that comes into our office. You know, Bryce Morrison does, you know, most of our retail strip leasing and out parcel sales. Patrick Rowley touches, you know, every single restaurant that we do. So Lindsay has, you know, Class A office leasing. So think we have a good team that kind of hits all the gamuts. If, if I have a good friend or a good client that comes to me and says, hey, I want to develop 100,000 square foot industrial property, obviously, I'm going to be on the team, but Will Leonard's going to be the lead. I mean, I know industrial, I know pretty well. I could do it just fine, but that's all Will Leonard,
That's he's a
does.
master.
Correct. So I'm not going to reinvent the wheel. So in our office, we partner a lot on listings and projects. Most of our listings have at least 2 brokers involved, if not 3. And sometimes because hypothetically, it's a retail center in some geographical area, so Bryce may touch it, but Rob High knows that some market better than him, so they partner together and kind of create some synergy there.
Awesome. And so when you were there, where did you become, how did the partnership agreement ever start? So you were there, the 2 of them are there. When did that, was that something that you were engaging them on, or they kind of came to you and said, hey man, you look like a great guy to partner with? Yeah. So when did you become a partner? So you said 2017?
For you to bring to the table at a level that they were like, look, this guy, he's gonna.
I mean, I can't speak for Brian and Ben. I'm not sure kind of what initiated the conversations. I mean, obviously, I'm very thankful for the opportunity. They've been great partners, and we all kind of,
Well, it seemed to have been become a lot in 2017. I mean, I've seen a lot of growth. I mean, you guys definitely cornered the market in this area, right? And, have the most visibility of the commercial listings in the market for sure. And, to be a boutique type brokerage like you are, and have such a strong presence in this market is impressive. I mean, because you're going against national, companies around here, and, really you guys seem to have 60-70% of the market cornered almost.
No, I mean, obviously, I really appreciate that. I think we have a great team. We all get along. We don't fight with each other. There's never been any sort of argument about commissions or people or potential projects. There's nothing confidential in our office. I know everybody knows what everybody else has going on. If hypothetically 2 people are chasing the same project and they find out, they don't compete, they partner. And this is really credit to Brian and Ben and the environment they created, the collaborative environment they created from day one. It's just, it's a very enjoyable work. And I think that just, helps with our success and creating value for our customers.
Well, that's awesome. So you got anything else, Cameron?
No, I think we've gone over our time a little bit.